Hi, my name's Cassandra Crowe and I'm Head of Consultants and Research for Allianz Retire Plus, powered by PIMCO. Today I'm delighted to be joined by Robert DeChellis, Retirement Strategist and Consultant to Allianz Retire Plus, and Tim Murphy, Head of Asia Pacific Research for Morningstar. Welcome, guys.
Thank you. It's great to be here.
So today I'm very excited to talk to both of you about retirement. And Robert, I might start with you perhaps, maybe from a big picture perspective. You've done a lot of work internationally and in the US. What kind of themes are you seeing in terms of financial advice and around retirement strategies?
Yeah, so probably two maybe macro forces to answer the question. One is just simply the demographic trend in the US, and I don't think it's too dissimilar here in Australia. 10,000 people started turning 65 in 2011. Gosh. And that'll actually continue to 2029. So you have a very, very significant cohort of the population that's shifting from an objective of the accumulation of wealth, now trying to figure out how do they actually aggregate all this wealth and to distribute it over retirement years that now can last in some cases as long as your working years. So there's been that sort of shift. And then the second is, given that the solutions and the innovation needed in distributing assets are dramatically different than the accumulation of assets, we are starting to see both the advisor community and the financial services sort of ecosystem in general start to look towards solutions to address this demographic shift.
Fantastic, thank you. And Tim, I'm interested, you deal with clients regularly, locally and across Asia. Are you seeing a similar trend when you talk about retirement?
Yeah, for sure the demographic theme is something that permeates right across most of the markets in which we operate. There's definitely some nuances and definitely some variance in sophistication, I would say, about how different people are dealing with that across the board. Certainly I'd observe in this region, Australia, I'd put it the more sophisticated end in terms of the conversations people are having, the way that they're thinking about how to evolve a traditional approach to portfolio construction, to meet a range of objectives that aren't necessarily the same as what they might have traditionally been. And so we're seeing evolution in the thought process around that, and then obviously then the building blocks that you need to put portfolios like that together are evolving and changing, and we're seeing new things come to market.
Yeah, it's great. It's encouraging to hear that Australia's forward thinking with this. And I guess perhaps to both of you, from a technical perspective, when we think about portfolio construction in the retirement segment, do you feel that we're actually able to construct retirement portfolios differently? Are we thinking about liabilities perhaps instead of assets and so forth?
Yeah, in fact, we've actually utilized a great bit of the work that Morningstar has done on this topic. In fact, we found them to be one of the first firms to really sort of address this issue that the factors that you consider during accumulation, i.e. alpha and beta, while still important in decumulation, there are other things to consider in terms of one's overall capacity for risk in retirement. The other is, again, a great body of work done by Morningstar, No Portfolio is an Island, really does speak to the need to look at a client more holistically in trying to manage an asset base against, again, a fairly long liability stream that one will have in retirement. So I think that the work is starting to be done in terms of creating awareness, but I would say that there's still a lot of opportunity for innovation in terms of my observation, both here in Australia as well as the US.
Yeah, fantastic. And I think that paper you mentioned, No Portfolio is an Island, I love that one, by David Blanchett. Yes. Perhaps, Tim, to talk a little bit more on that, I know he calls out that when we think about portfolio construction, traditionally it's been looking at risk and return of traditional asset classes, but there's more important, potentially less quantitative factors like human capital. Yeah. What's your view on that?
Yeah, so I mean, the premise of the paper is exactly that the factors you need to think about building a portfolio that helps meet the needs of a client goes beyond just what those investment options are in that investment portfolio. So things like human capital, which you've mentioned, so that's the idea of a person's future earnings or income streams from their work. So that tends to be, or the balances associated with that tend to be inversely correlated with a person's accumulated wealth. Obviously, the younger you are, you have more future earnings potential, and that reduces as you go towards retirement. But thinking about things like the industry that someone works in, is that correlated to some of the investments, for instance, and that you need to think about the context of that. So, for instance, if someone who works in the property industry, doesn't make sense to have a big property exposure in their portfolio because their salary and main earnings are likely to be negatively affected at the same time as if there was a property downturn, for instance. So thinking more holistically about things like that, but then also, how does that interact with assets like the family house or entitlement to the age pension or whatnot as you get towards the more retirement end. And so, what David did in that paper was really try to, focus the thinking on how we build and bring all of those different aspects together in the thought process beyond just looking at the investment assets that are in play.
Yeah, I think it's a great piece. And I guess if we think about products that are available, do you think that, the market has innovated in line with this work that's been done that is a bit more holistic?
So speaking from a US perspective, I would say that if you look back right after the dot-com bubble, we really did, just given the carnage in financial markets at that point, people really did start to think about sort of protection in general as a category, whether it's protection and accumulation or starting to think about addressing longevity in terms of lifetime income. So I do believe that we have seen innovation around income here more recently, both in the US and of course the work that Allianz and PIMCO have done with their new offering, starting to also address transition risk. So if you think about some of the most critical years, it's really those years leading up to retirement and the first couple of years in retirement, where you can potentially have an episodic event that could severely damage your overall retirement plan. So I do think that we have started to see some innovation, but to Tim's point, I think that there's still lots of work to do to understand the client's broader portfolio and how other pieces of the portfolio will feed into one's overall success.
I think that's right, Robert, and I think also thinking about the behavioural tendencies that come out when we look at retirees, loss aversion, for example, really intensifies when you retire, as opposed to how you might feel about the same loss when you're accumulating. I guess, Robert and Tim, do you feel that when we're constructing portfolios, we can really accommodate those behavioural tendencies into them as well?
To a point, I think we can, and there certainly has been some innovation, I'd say, in the last decade along that front. So, if we're thinking about sequencing risk, for instance, the idea that if you have a big drawdown at or around or just after retirement, your ability to recover your savings pool from that is problematic. And so, we've certainly seen newer strategies come to market that have lower volatility profiles to try and address that, in conjunction with different types of income streams or income-based products, or annuities. I think there's definitely been no silver bullet so far that in market to solve all of these problems. But certainly the fact that there's lots of discussion and increasing number of solutions coming to market to try and address these. Certainly helps put the building blocks in place to building better retirement portfolios over time. But I think the one thing that we really do need to continue to see is more data and more information that we can use on the different elements of assets, human capital, things around just the investment selection. So the idea that the better information and technology and data we're able to pull together to make more informed decisions around some of these things, I think that's going to be really important development, hopefully over the next 10 years, so that we can help people deliver better outcomes.
Yeah, the behavioral piece of this, Cassie, is extremely important. We, I think, discussed a recent study that BlackRock did about the quality of life for retirees. And what you're seeing is that retirees are sort of systematically reducing their quality of life because of this fear of running out of money. So there's a degree of comfort with spending dividend income or interest income or rental income, but to have them take that next step where they'll need to, let's say, monetize an asset and convert that to income is far more difficult. And I do think it gets to what Tim was saying about there's a behavioral sort of aspect to human capital, because you have this sort of confidence that I'm working and I continue to get a paycheck, and that paycheck gives you sort of that level of confidence. When you're retiring and don't have that sort of ongoing human capital, there's a behavioral piece of that I do believe we need to stay focused on.
I think that's right. It's definitely the behavioural piece, and also the data and information piece as well is critical. So I guess just to pick up on what you said, Robert, around longevity, and we know the need for income and people are living for such a long period of time now. How have you, I guess, what creative ideas do you have to kind of manage that you've observed overseas?
Yeah. So longevity, one of the things I think we would all agree, both here in Australia as well in the US, that when governments and companies moved away from traditional pension plans, I mean, I can tell you that in the US there was lots of energy around going from a defined benefit plan to a defined contribution. People felt like they had more control of their retirement. Returns were certainly very promising in those days. There was flexibility. I could move from one company to the other and take my retirement with me. However, probably one of the biggest misunderstood consequences from that shift from governments and companies making that decision was that all the longevity risk went from the company and the government to the individual. And as we all know, as an individual, you can't pool risk, right, against anything. It's sort of, you have yourself. So that's where I believe this idea of creating products that, at least for part of a client's portfolio, can give them that level of assurance that they will not outlive their assets, because I do think one of people's greatest fears is just that, is running out of money. And the longevity piece is one that, as I said earlier, if you're a couple today retiring at age 65, one of you has a 50% chance of living into your 90s. That's
a long time.
That's a long time.
Yeah, and I know Allianz actually put out a piece where they'd surveyed retirees and found that retirees were more fearful of running out of money than actually death, which I thought was quite a powerful observation. I mean, Tim, what are your thoughts around this issue from a Morningstar perspective?
Yeah, so on the idea of longevity, it's certainly an important consideration as part of the financial advice process. And so part of that is looking for products that can help solve part of this need. Part of it goes to the behavioural aspects too, though, of maybe you need to adjust a plan through retirement. You can't just set a plan for someone at 65 in terms of forecast cash flow and think that that's going to remain unchanged for the next 10, 20, 30 years if you're lucky. So the ability to be dynamic in the retirement phase with your plan around that is where the value of financial advice becomes really important in terms of interacting that behaviour with the products that you've got to help meet that ultimate objective.
Yeah, totally. I think being dynamic is absolutely a critical piece.
And Morningstar, again, has done some great work on trying to focus on sort of outcome-driven objectives or goals-based planning versus historically in accumulation, we were very return-driven. Not to say that returns are not important in the decumulation of assets, but to Tim's point, you need to be far more intentional about what it is you're trying to solve for.
Great. Well, it's been really terrific to talk to you both today about retirement. I think we all agree it's an area we're all very passionate about and we're excited to see innovation. So thank you very much, Robert, and thank you, Tim.
Thank you.
Thanks, Cassie.
Thanks.